Okay, happy weekend to everyone. Today's episode is going to be fun. We're going to talk a little bit about the future of the super terrible index or STI. All right. And I love the 1M65 Telegram group because um, Mr. Lu is very talented at coming up with ideas that become viral very quickly. And then it gives smaller influencers like myself the ability to just work on it and come up with some constructive comments about some of these ideas that arise from the 1M65 Telegram group. Okay, so we're going to talk about the super terrible index, right, which is the moniker given for the Straits Times index some time ago. Right, and at the moment, the STI ended last week on the 11th of July at 4,087 points. And the year-to-date return is not too bad, 7.28%. Nothing to shout about, right? But it's one of those rare years where you actually have a positive return. So it's something that I think investors should be happy about. And so actually, on hindsight, as the index has done rather well, maybe the STI does not deserve this super terrible index moniker. But I think my job, at least for me, I'm not so interested in how it has done in the past, but I want to predict how well it would behave in the future. All right, so that's a difficult task. All right, okay. I hope you guys appreciate this. Now, let's talk a little bit about why we ended up doing so well. Is it because we are good? Is it because Singapore is such a great market? Actually, that has never been the case, right? The STI has always been a bottom feeder. In 2020, it was the worst performing stock index in ASEAN. Okay. What actually happened was Trump started to threaten the world with tariffs in April 2025. And so, in response, fund managers, American fund managers, began selling some US stocks. And they began to diversify their stocks by buying companies in the rest of the world. Okay, so there's money flowing out from the US and then flowing to equities in different financial markets on planet Earth, right? And so Singapore is one of the beneficiaries from this flight to quality because we have a strong currency, stable government. So I think fund managers want to park the money in, probably temporarily, right? So that as the Singapore dollar strengthens and the US currency weakens and the stock market drops, there is a way for these fund managers to move the funds back into the US, right? Likely after the midterm elections. Okay. So another possible reason is that Singapore is one of those rare countries with a surplus, right? We buy more from the US than the US buys from us. So the tariffs levied on Singaporean goods is only 10%. And we are the least affected compared to our other countries, right? We are in the same league as the UK, right? The tariffs that we are facing is only 10%. So that's another reason why it's a smart move for a fund manager to just temporarily move some of the funds over to Singapore. Of course, it's up to the Singapore government to figure out a way for them to keep these funds within the country, right? And that's a big question mark that I can't answer. We don't know how good Singapore is at doing that. Okay, now you can get information on the STI ETF, the Super Terrible Index ETF. All right, and here this is the fund characteristics as of 11th of July. The dividend yield is quite good at 4.24%, so you can imagine why people like to move their funds here. But more interestingly, the price earnings ratio is 12.69, which means that actually the global average is about 14. So at 12.69, I would say that the STI is still relatively cheap. Okay, all right. And what can we learn from this number? Okay, now using the price earnings ratio, we can predict the long-term returns, right? So the best predictor of future returns is this thing called Shiller's cyclically adjusted price to earnings ratio. But this data is not free. I couldn't get it for free. Otherwise, I'll be able to do an article on this, right? But we will use the next best thing, which is the PE ratio of the STI. And this number is 12.69, right? So how do we predict the long-term return of the STI, right? Net of inflation, the real returns, the estimate is 1 divided by the PE ratio, right? So 1 divided by 12.69, you get 7.88%, which is not too bad, right? 7.88%, okay? And this is what our markets in Singapore can give back to the shareholder over the long term, right? Over the very long term. Okay, so if inflation is about 2% in Singapore, then it is 7.88% plus 2% or 9.88%. So not too bad. You can still get double-digit returns from the Singapore market, rounded up. Okay, if you do the same mental exercise for the US, their PE ratio is closer to 28. So the expected long-term return is much lower, maybe 5.5%. All right. Yeah. So that is how for long-term investors we play the long game, right? We find uh, countries with a very low price to earnings ratio and we invest in them. Okay, and on top of it, there are a lot of benefits investing in Singapore because of a stable government, our low tariffs. So I can expect things to look quite good for us in the 6 month or 12-month future. Okay. All right. So this sums up the future of the STI. It's not too bad with returns closer to 10%. Of course, one major positive is that our central bank is trying to stimulate the markets. New policies, right? Like $5 billion into the fund management industry to invest in local stocks. So that is one piece of good news. Okay. Now, however, do take note that STI, 50% of the index is local banks, which may underperform. As interest rates decline, banks normally underperform and you drag down the performance of the STI along with it. Okay, but right now the banks are claiming that they can earn more in wealth management fees, and on top of it, they are actively buying back shares on the stock market, right? So hopefully that would be able to buoy, right, the STI over the medium term. Okay. Okay, now do note that obviously this is we also need to be aware of the history of the SCI. It has been underperforming for a long time. That's why it was called the super terrible index. Okay, the US has always been more exciting because of these narratives arising from the tech sector, AI, right? So that's something you want to take note of. All right. So everything I say might not come true, okay, but that's the way things are in the financial markets. Okay, so my own attitude towards the STI is that I'm a very textbook dividends investor. We just want a powerful way to convert a lump sum of money into a perpetual cash flow above 5%, right? And Singapore lets us do this with minimal taxes. So my loyalties as a local investor has been here for 20 over years. And there were many years where I get made fun of by a lot of people for being a very stubborn dividends investor in Singapore, right? Which is something I actually enjoy. And folks who invest for dividends in Singapore, all the uncles and aunties, they would not mind if markets go back in time. If you become a cheap and forgotten marketplace, it's just a time for me to reinvest my dividends and become wealthy over time, right? So we would stubbornly invest until we die, and then our children will continue to do it in their generation, right? So yeah, so I'm grateful to the 1M65 movement for labeling STI the super terrible index. No hard feelings. I actually am very grateful because as the idea sticks around, it'll be easier for the dividends investing group to accumulate more steady high yielding counters. All right, so please don't take this as a video. Don't go and troll Mr. Lu. Mr. Lu is a great guy. He's my friend. We've appeared in some panels in Sydney before, right? So be nice, all right, in 1M65. And if you like my content, subscribe to my channel. You can buy me a coffee here. If you want to listen to my life story and come for my preview, Google ERM intro and take the first link. And I will see you the following week where I can come up with more interesting content. Thank you very much.